the way you can manage this risk, one, firstly, I don't think you should keep a few $100 million sitting in a bank account ever. I don't care what bank it is. The discipline we've followed from the beginning of time, if you remember, we were betting against the creditworthiness of AAA rated institutions beginning in 2002, right? So I've been bearish on the rating agency's ability to assess creditworthiness for a long time. So the approach we take here is, other than cash we need for daily needs, we keep that number pretty small. Everything else is in a U.S. Treasury money market account, or we own U.S. Treasury bills directly. So we're not taking bank risk. We're just facing the U.S. sovereign. And then the cash we keep on hand, we do keep at a JP Morgan or at our prime broker, Goldman Sachs and UBS. And we monitor those institutions kind of very carefully. But actually, there's a case to be made for going back to Silicon Valley Bank now, okay, because they're got a full faith and credit guarantee on deposits, and they're actually trying to, apparently they're saying they're open for business, they're making loans, they're doing whatever. But it's a bit of it's now a quasi-governmental institution. I mean, I think the right thing to do there is just to recap that institution. Again, we need a system-wide deposit guarantee, and then we need FDIC insurance with appropriate premiums so that these smaller banks can operate. That network of banks is important, for the farmer in Iowa as much as it is for the venture capitalists in Silicon Valley.
Does kind of wall-to-wall guarantees on deposits not just allow for constraints to be removed and bad performance and behavior to be allowed? So
again, we need a temporary government guarantee because we don't have a non-governmental insurance system to support it. Right? The FDIC system is not a government guarantee of deposits. It's a government guarantee in exchange for appropriate premiums, right? The FDIC has $125 billion of premiums it's collected sitting in an account that's to backstop, insurance on deposits. It's a good system. The problem is that the amount of insurance available per account is very small, right? Small, not small for your average American's checking account, for sure. It takes care of that. But it doesn't take care of any kind of decent-sized business that has to have money on hand for payroll or working capital or otherwise. And you can't have, millions of small businesses trying to assess the creditworthiness of banks on a regular basis. And by the way, the creditworthiness can change dramatically. Silicon Valley Bank was a very solvent bank until rates moved a lot in 12 months.
Bill, if you were sitting in charge of the Fed, what would you do today?
I would call my colleagues at the FDIC and the Treasury. I would say, let's put in place let's announce to the world a temporary deposit guarantee on all deposits. Let's get busy quickly to create greater insurance levels, and let's get that system announced and launched quickly. It shouldn't take a lot of time, right? We already have a regime for $250,000 deposits. We just need to increase the amount of deposit guarantees that are available. We've got to first stabilize the banking system, and the Federal Reserve's principal job is financial stability. Without financial stability, we don't have any kind of stability, let alone U.S. dollar, U.S. interest rate stability. So once you go solve that problem, now Mr. Powell has an upcoming meeting where he's got to make a decision on interest rates, and each move of the lever, if you will, or each crank of the cranking up rates, puts pressure on the system and cracks emerge. And we've seen more of that crack. We've seen glass breaking. And so I think he's got to be very, very thoughtful about whether we raise rates here or whether we pause. And so I think there's a decent chance Powell says, we're not raising rates. We're witnessing, again, if they can I haven't checked the news for the last couple of hours, but if even the form, here's an unusual thing. Sheila Bair was an FDIC chair in the Bush administration, or actually a while ago, maybe even Obama, Republican. She's in effect criticizing the FDIC for not having selective deposit guarantees instead of putting in a temporary guarantee, redoing the system. She's making my argument in today's FT that we need that to happen, because if that doesn't happen, all these deposits drain out of these regional banks. They're going to stop lending. If they stop lending, the economy's going to come to a halt, right? It's going to slow the economy very aggressively. So I'd be very wary about raising rates until we've solved this regional bank problem. And it's not just regional banks. It's people are going to start thinking about their small community banks and how solvent they are. There's a run that we can't have another bank closure. We have one more, and it's like, and it's going to get messy.